What I want to do here moving forward is I want to talk about individual places that we can start putting money, but instead of talking about specific product, because if we go out there and we try to choose an individual product, I could probably find millions of different investments that are out there. So we'd get bogged down on getting specific. What I want to do is I want to just generalize this and put three different categories, which would be three different types of money. One of the things that I think about were my parents, a story about my parents. When they told me that they were ready to retire, the thing that they told me was the reason why they were ready to retire was because of the rate of return that they're earning on their investments. They were saying that they can earn 8% per year on their investments, so that was going to be plenty of money for them to retire. They were just focusing on one component, which is the rate of return. And so the point of this video is really that there's other things that we need to focus on other than the rate of return. That's only one component. So let's move on to talk about the three different types of money.
Now this piece, you guys at home actually have this available too. Again, just scroll down under the resources tab. You could actually download this sheet and go through it with us. You know, fill out all your accounts and keep a copy for yourself.
Perfect. So the three different types of money that we're going to have is we're going to have taxable money, we're going to have tax-deferred money, and we're going to have tax-free money. What we're going to do is we're going to go through these one by one and just talk about what each one of these are.
Okay.
So the first type of account that we're going to have is going to be taxable money. This is money that you're going to be taxed on every single year. How do you know that you're getting taxed on this money? You know this because you get a 1099 at the end of the year where the IRS says that you owe taxes based on the interest that you earned. Mm-hmm. So can you think of some type of accounts that fit into this category?
Savings, CDs,
yep.
Mutual funds.
Okay. Perhaps bonds. These are all different types of individual investments that you can choose, but generally speaking, they fit inside this bucket of being a taxable investment. Now, if you're going to pay taxes, especially if you're in the top 25% of wage earners, if you're going to be paying taxes on one of these types of investments, why would somebody have money? Why do you think people would put money into savings and CDs and mutual funds?
Because it's liquid. They're
yeah,
able to...
exactly. It's because generally speaking, these types of accounts are going to be liquid. Mm-hmm. So we do want to have some money in these types of accounts regardless of how much taxes we're going to be paying. And that's because it's liquid. So from a taxable standpoint, we don't want to have too much money in one of these taxable accounts, but we want to have enough to maintain a minimum amount of liquidity.
Got it.
The next type of account is going to be a tax-deferred account.
So those 401ks,
perfect.
IRAs.
Yep. So you said 401k, yep. IRA. You might have a SEP IRA. You could have a 457, a 403b. These are all different individual tax codes addressing these types of tax-deferred accounts. The term for these are a qualified account that describes this. This basically means that it qualifies as a certain tax treatment. So the two things that these accounts have in common are the manner in which you pay the money in and the manner in which you take the money out. So when you pay the money into one of these types of accounts, this is how it works. Let's say that you make $100,000 of income, and you choose to defer $10,000 of your income by putting it into your 401k, let's say. What happens is the amount of taxes that you're going to, the amount of reportable income tax that you're going to have at the end of the year is going to get reduced down to $90,000, which means that this $10,000, all you're really doing is postponing the taxation of that money to some future point at some unknown tax rate. In the previous video, we talked about how we're at historically low tax rates. Yeah. So the question I have is, from a tax diversification standpoint, does it really make sense to postpone taxes to some future unknown point if we're at historical low?
It doesn't make that much sense because, like we proved in the other video, that it's likely going to go up, and you're going to be paying more taxes.
True. So that's the second characteristic it has of the money was when you take the money out. It's going to get taxed. This is taxed. When you take this money out of this account, it's taxed as something called ordinary income, meaning it's completely ordinary. It's just as if you took it the day that you earned it. So this agreement that you're entering into with putting money into a tax-deferred account, this is like borrowing money from the IRS, except that instead of borrowing money from the IRS, you're borrowing money from your uncle. Let's say you need some money. You go down to your uncle. You ask your uncle to borrow money, and he says, okay, that's fine. I'm going to give you a certain amount of money, and you don't have to pay me back this money now, but at some future point, you're going to have to pay this money back to me. And you ask him, okay, well, what am I have to pay you back? He says, well, I don't know what you're going to have to pay me back today, but when you pay me back at that future point, based on how much money I need at that time, I'll determine the rate at which I'm going to charge you. Would you ever enter into a loan agreement under those terms?
No.
Absolutely not, because you don't know what you're going to be paying.
Yeah.
This is the same thing that you're doing when you're putting money into a 401k. You're entering into a loan agreement with Uncle Sam, the IRS, and they're going to charge you a tax rate in the future at some future unknown rate based on their need at that time. If we framed it like that, people wouldn't be putting an incredible amount of money in here.
Yeah.
Now you have a 401k, right?
Yep, I do.
Now why are you putting money into a 401k?
Because of the company match.
Yeah, and so even though there's a problem with the money that you put here in the form of how much taxes you're going to be paying, if you're being matched money, 5%, that's free money. It absolutely makes sense to put however much you need to put into your 401k to get the full match. It's 100% rate of return. But everything over and above that, the question is that should you consider putting that somewhere else where you might not have to pay as much taxes? That leads us up to the third type of money, which is going to be a tax-free bucket.
Okay.
Now, if I were to go ask whether it was clients or financial advisors, what everybody's go-to tax-free investment would be, the overwhelming majority of answers I'm going to get.
Municipal bonds?
Yeah. Is municipal bonds, a muni bond. This is what everyone says that they should do. Now, municipal bonds are free from federal income tax, which is why they get that label of tax-free. Mm-hmm. But they're not necessarily free of state income tax, right? Because you have to buy the bond within the same state that you live within generally to not have to pay state income tax. Not only that, but the interest that you earn inside a municipal bond, it's something called provisional income, which means that it's going to cause your Social Security going to be taxable. So when you retire, that interest you earn is going to make more of it taxable. You're going to pay more taxes. So you're not going to be paying on it directly, but other money will become taxable. So a municipal bond really does not count as a tax-free investment. Of all the different types of places you can put your money or different types of accounts you can put your money, the traditional place that is truly tax-free is going to be a Roth IRA. So if a Roth IRA counts as tax-free, why doesn't everyone put all their money into a Roth?
But isn't there some type of limit that you can put into it?
Yes, exactly. There's two limits that are going to keep us from putting an unlimited amount of money in there. The first is going to be the contribution limit per year. So depending on your age, you're only going to be able to put $5,500 to $6,500 per year into a Roth IRA. It's not very much money, specifically if you're in the top wage earners.
Yeah.
You can't retire on $5,500 per year of a contribution. But there's a second catch, and that is if you make too much money, then you can't put money into one of these accounts either. If you're single and filing single, the limit is right around $115,000. If you're married, the limit is going to be $189,000. So if you make more money than this amount, then you can't even put the money into the tax-free account. So the people that have the tax problem can't put money into the tax-free account. So these are the three different types of money. And I think the important point to take away from this slide is that no matter what type of investment you choose, whether when we talk about individual product, you can lump them into one of these three different categories. And I really believe that you need to have money in all of these different accounts. However, and you don't want to have all your money into just one. If you have money in just one account, for example, you have too much risk. But really, the ultimate goal is to figure out a way to get as much money as possible into our tax-free account. So what we have here is we have a list of different types of benefits that you're going to find across any type of product that you can choose to put your money. We're going to put a category here that says what you want from an ideal investment. And we're either going to have a green box or a red box saying whether it's good or bad. So our goal here is when we look at individual investments, we want to have green boxes on this column.
Yeah, okay.
So the first one is the risk. So in order to have what we want, if you had an ideal investment, would you want risk or no risk?
I would say no risk.
You don't want to lose your money.
Yeah.
Which goes to the next one, which is you'd want guarantees. You want some sort of guarantee in where you're going to be putting your money. So that's what makes it green. Penalties, when you put money into a tax-deferred account like a 401k or an IRA, there's early distribution penalties. So you don't want any penalties associated with that account.
Okay.
Liquidity, use, and control of your money means that with one stroke of the pen that you can access your money and you can use it for emergencies, medical bills, anything like that. So you want liquidity to use to control your money. Protected, what this means is that if creditors come after you for debts or anything like that, can they go over after this type of account to seek recourse? And we want this to say yes, it is protected from creditors. The next is leverage. This is an advanced strategy that we're going to be talking about in a different video. But can you post this as collateral and use it as leverage in order to earn a high rate of return?
Yes.
Tax deferred means that you're not going to be paying taxes on the gain every single year. We don't want to do that. Tax free means if we can never pay taxes on that money, that obviously be ideal. Collateral, again, is that advanced strategy where we can post as collateral and borrow against it rather than having to deplete the account to make a purchase. We're going to talk about that. We want to have the ability to make tax deductible payments, which is going to mean that when we make a contribution into it, that we're going to be postponing the taxes like a 401k. Disability benefits means that if you become disabled, that there's an extra benefit that you get. We all want that in the type of ideal investment. The next thing that we're looking for is the wealth transfer. And what this means is what happens to the money that when you pass away. Ultimately, we're all going to have a beneficiary on the accounts that we have. And so what happens to the money when it goes to your beneficiary, whether it's your spouse or whether it's your children, and how that money gets taxed is going to be very important. Is the IRS going to take a portion of that money away, or is that money going to blossom into something greater for your beneficiaries?
All right, so just to recap, these are all the benefits that we would be looking for in a financial vehicle.
Yeah, these are all the benefits we're looking for. These are ideal benefits. Now, if we circle back to the other slide where we talked about the 3 different types of money, hopefully you all printed out the sheet and wrote down the different money that you have in each one of those categories. And if you think about it, each one of those individual ones, and you break them down into these individual investments, first is, do you have the right amount of money in each of the buckets, or do you have too much money in one of the buckets? And then if we narrow it down further and we say, let's look at the actual benefits of whatever investment you have, do they actually line up with what you're looking from an ideal retirement account?
Yeah, and that's the next video that we're going to go into. We're actually going to go through one by one.
Yeah, the next video, what we're going to do is we're going to go through each different type of account, individual retirement accounts, and we're going to compare them to what we want to what you actually have. And I think that you're going to be surprised that what you have might not be exactly what you want. And Jordan's going to be coming in and comparing these accounts for us.
All right. Well, thank you very much, Kevin, for being with us today.
You're welcome.
And that's it for video 2. So if you scroll down, you could click on the third video, which is the traditional way of doing things. Thank you.